Can you have excellent long-term investment returns with very little effort? Yes. Or at least historically, that has absolutely been the case. But has that been your experience? I don't know. But stick around and I'll show you how you can do it and why most people don't. My name is Reese. I'm a chartered investment manager, a fellow of the Canadian Securities Institute, and a financial planner. And in this video, I am going to show you how profoundly simple it is to do very well with your investment portfolio over time. I know. For most people, this sounds like an absolutely absurd or stupid thing to say because it's been the absolute opposite of their experience, or at least it's been the opposite of everything that they've heard. But the proof is in the pudding, so let's eat it up. This is the S&P 500. It's an index. Is it the holy grail and the only thing that you should ever own? No, but it's pretty stinking solid, and it's probably the most referred to investment option on the planet. Basically, the S&P 500 is a collection of 500 of some of the biggest and best run businesses in the United States. And you can buy pieces of all of these businesses simply by buying this one index, and it's dirt cheap to do it. Super easy. And now you own 500 of some of the best businesses in the world. Done. No farting around, no analysis, no research, no guessing, and no massive fees. But is this a good idea? If I would have done that with all of my money and nothing else, how would that have turned out for me? Great question. The results are shocking. I'll post a link to this website below so that you can play around with these numbers yourself. But for now, let's go back in time 40 years. So we'll plug in 1983, and it's the beginning of 1983 to the end of 2022, which is a full 40 years. And let's invest $10,000. And there we have it, 10 grand invested into the S&P 500 at the beginning of 1983 turned into over 691,000 by the end of 2022. That is an average annual rate of return of 11.17%. It's massive. And if you want to see how you did after inflation, no problem. 8.22% average per year. Delicious. Now, what if you invested 20 grand? Nearly 1.4 million after 40 years. What about 100 grand? Nearly 7 million. But maybe 40 years is too long. What if you only had 30 years and only 50 grand instead of 100? There you go, 800K with an average rate of return of just under 10% a year. These are serious numbers. And remember, these are based off of just one lump sum deposit. You just dropped in your money, walked away, came back decades later, and gave yourself a nice pat on the back. Well done. Zero effort. Of course, had you added more money along the way, then all of these numbers would be even bigger. So then why didn't this happen for you? And what can you do about it? Well, the biggest culprit, surprise, surprise, is fees. In Canada, we have some of the biggest financial services fees in the world. Most people are paying well over 2% a year. And frankly, most people would have a hard time explaining to you what their advisor actually even does for them. That said, some advisors are awesome, and they're worth paying for because they can help you add far more to your net worth than you would have been able to accomplish without them. However, in general, I think most Canadians do not have that and are getting pretty fatigued with the whole stereotypical do nothing, charge a ton advisor. Either way, excessive fees can eat up a huge chunk of your returns. That said, even if you go and do all of this on your own without an advisor, there still are costs involved. So your returns are never going to be quite as good as what the actual S&P 500 did without any fees. But the raw costs are really low, and so you can get pretty stinking close if you're comfortable doing all of this yourself. And if you're not into doing everything on your own, like many people aren't, you can still find really great firms out there that don't overcharge. And I know that because our absolute highest fee package is still a third less than the industry average. So it does exist out there. You just have to look for it. Another culprit is our emotions. And believe it or not, this one can be just as bad or worse than excessive fees. Both fear and greed can mangle us, and they often do. In my line of work, selling out of panic in a market downturn is known as the big mistake. And it's called that because it is a big mistake to sell when markets are down. But people do it, and they do it often. It is a very easy way to lose a staggering amount of money in a heartbeat. Fun fact, all the numbers we have been looking at today are numbers as of the end of 2022, when the S&P 500 was down nearly 14% off of its peak. So even in the middle of a storm, the numbers are still delicious over the long run. You just have to hold. Do not sell in a market downturn, ever. And don't get greedy in an upswing either, or chase investment fads. There will always be something shiny to lure us away from the tried and true, but don't do it. And I'm not saying you can't explore a little, but be very wise with the bulk of your assets. And yes, there are other culprits, but I want to keep this video short and to the point. The S&P 500 is not the only great investment option out there. It's just a very clear and easy to understand example of how we can do very well over time with extraordinarily little effort. And yes, it's definitely a nice chunk of my portfolio, but it's not the only thing in my portfolio. It's just one option, and it only has exposure to one country. There is a big world out there with a lot of great businesses that I want to own a piece of. So do your research or pay someone competent to do it for you and get yourself a well-built, diversified portfolio. Just watch those fees, ride out the storms, and let it grow.